All right, good evening once again. So tonight we'll continue our discussion on investment appraisal, looking at a niche in that aspect, which is taxation in discounted cash flow. Taxation in discounted cash flow. Now, when we talk about taxation, what is bringing about taxation in the issue of investment appraisal? Why taxation in investment appraisal? Yes, the reason is this. When a company incurred qualifying capital expenditure, that is assets, the company is entitled to claim capital allowance on the qualifying non-current assets. Why do we have to come up with the issue of capital allowance and taxation? As part of the tax relief, tax incentive given to organization to go into manufacturing, to invest into certain areas of the economy, the government can come up with certain reliefs that by the time you venture into agriculture, you're enjoying this kind of relief. So in order to encourage individuals, organizations to venture, to diversify into manufacturing goods and services, there is always a relief in terms of capital allowance. In terms of capital allowance. Now, when we talk about capital allowance, instead of saying depreciation, in tax, we refer to it as what? Capital allowance. We refer to it as capital allowance. So instead of saying depreciation, we refer to it as what? Capital allowance. So this capital allowance is an allowance granted to companies for incurring what? Qualifying capital expenditure at a specified period of time. So taxation in investment appraisal will address issues such as tax liabilities, we address issues such as tax savings, and we address issues such as timing of the cash flows. So when we talk about tax liability is calculated by, sorry, I don't have a note for this. Let me see what to do now. When we talk about tax liability, this tax liability is calculated by multiplying taxable profits with the company tax rates. Yes, if you are used to conversant with financial statements, when you have tax before profit, for you to get your tax liability, you must determine what your taxable profit. Once you determine your taxable profit, the tax rate will be multiplied by the taxable profit to determine what? The tax liability. And also we have what we call the issue of tax savings on capital allowance. Now, tax savings is a form of tax shield. It is reducing your tax. The fact that you are investing, buying a capital expenditure, instead of you paying more tax, you pay less tax. And that is where the issue of tax savings set in. So tax saving on capital allowance, this is calculated by multiplying the capital allowance with the company tax rate. What is capital allowance? Capital allowance is a form of what? Depreciation. Form of depreciation. But in tax, we don't say depreciation, we say capital allowance. Capital allowance. So for you to determine your tax savings, I'm going to show all this on the slide. I'm going to type there. To get your tax savings, it will be the value of your capital allowance multiplied by what? The company's tax rates. Multiplied by the company's tax rate. So these things are very important for us to solve questions on NPV. Now, to calculate issues of capital allowance. There are two approaches to calculate capital allowance. There are two approaches to calculate capital allowance. They are not far-fetched from what you know. One, we have the straight line method. We have straight line method. Straight line method. Straight line method. So when we talk straight line method, it's the method in which same amount is a method in which same amount is charged yearly throughout the project's year or throughout the project's lifespan. Yes. Please, can you see my screen? Even though I'm not yet, I'm not showing you what I'm saying. Can you see the screen, please? Hello, can you see the screen?
Yes, sir. We can see your screen, sir.
Yes, sir. The screen is showing.
No problem. All what I'm saying, I will present them in words. Yes. So when we talk about capital expenditure, we are talking about non-current assets. So in normal accounting, depreciation is charged on non-current assets. So depreciation is not an allowable expenses when it comes to tax. But capital allowance is granted in place of depreciation in the tax world. So capital allowance is also called what? Tax allowable depreciation. So this capital allowance can be calculated in two ways. Take note, in two ways. One, using the straight line method. Using the straight line method. Using the straight line method. Mr. Shaibu, any question, please?
Yes, I think you are repeat what I want to ask you for.
All right.
Issue of a straight line method. The second one, I didn't mention it. That's what I want to ask you first. Thank you, sir.
All right, sir. So capital allowance. Yes, don't just for the straight line method is a direction, but for the reducing balancing method I will talk about, I will show the format. So just follow. Yes, just follow what we'll be presenting because these are additional. Once you see a question, these are issues that will form the additional notes, the additional information, and you need to work for them to be able to solve questions on MPV. So we have the straight line method. That is methods of calculating what? Of calculating capital allowance. Calculating capital allowance. We have the straight line method. The straight line method. And when we talk about the straight line method, this is a method in which same amount is charged yearly. Yes, this should not be new to us, as we have many methods of calculating depreciation. Some of the digit methods, the reducing balancing method, straight line method, evaluation, and the rest. So in straight line method, our formula is what? To calculate depreciation using straight line method or capital allowance now using straight line method. The formula is what? Is what? Your costs minus what? Minus scrap value. Another word for scrap value is what?
Residual value.
Residual value. So it is cost minus scrap value divided by what? The useful life of the asset. So divided by the useful life or estimated useful life of the asset. Useful life of the assets. So where the question stated clearly in the additional information that capital allowance is to be charged using straight line method, it makes the work very easy. But I know in most questions, they will not come up with this approach. They will come up with reducing balance method. The reducing balance method. So where you have a question that says that what you should compute capital allowance using straight line method, all you need to do is to go to the question, determine the cost of the investment or the assets, less the scrap value where it is given. Some questions will tell you that scrap value will be nil, will be zero. So where it is not given, it will be cost divided by what? The useful life of the asset. The useful life of the asset. Now, there is something we must take note. In our financial reporting, there's what we call the carrying amount. What is the carrying amount? The carrying amount in financial accounting is what? Is the costs less what? Depreciation. You have the net book value, which is also termed as what? The carrying amount. In taxation, that carrying amount is called what? It's called the tax written down value. It's called tax written down value. It's called tax written down value. Now, there are certain things we must note also in solving questions or that involve taxation. Taxation. In solving questions that involve taxation. When we dispose an asset, we dispose an asset and the value of the asset, the disposal value is greater than the scrap value. When the disposal value is greater than the scrap value, we have what we call what? The balancing allowance. Let's put down all this. These are very key terminologies that we must know. We are still going to solve an example on the straight line method. I'm coming back there. Well, let's just note. Let's note this. So let's say, for the purpose of investment appraisal, for the purpose of investment appraisal, for the purpose of investment appraisal, the types of capital allowance, include to say one, you can say initial allowance. Initial allowance. When we talk about initial allowance, what are we referring to? This is an allowance that is claimable once in the lifetime of the asset. Yes, for those of you that are used to taxation, there are various forms of allowance. There are allowance that you only charge them immediately you obtain the asset. So initial allowance, this is claimable. This is claimable once in the lifetime of the asset. Once in the lifetime of the asset. From the word initial. When we talk about annual allowance, Everybody should know that. This is what? Annual allowance. Talk about annual allowance. This is an allowance that is granted every year. Every year. Until what? Until final disposal. Until final disposal of the assets. Now, the key ones that are very important and prevalent when you are solving questions on NPV, investment appraisal, we have the issue of balancing allowance. Balancing allowance. What is this balancing allowance? The balancing allowance, this is an allowance that will arise. This allowance will arise when the tax written down value. Tax written down value. How do you express tax written down value in short words? Tax written down value. So when you see this, you know that we're referring to tax written down value. These will arise when the tax written down value from the preceding year. From the preceding year. You know, these are terminologies of tax: preceding, penultimate, ultimate, and the rest. From the preceding year is higher. The preceding year is higher than what? Than the sales proceed. It's higher than the sales proceed. Sales proceed. Any question? At final disposal. So where we have it in this form, tax written down value.
Sorry, sir. Hello, sir.
I'm with you.
Then that initial allowance, you wrote this is claimable. I think you meant once, and you wrote one there. I don't know if I'm right or I'm wrong here.
This is claimable once. So the tax written down value, where the tax written down value is greater than the sales proceed, we have the issue of balancing allowance, where the tax written down value is greater than the sales proceed. So in a question as you solve, and the balancing allowance, the sales proceed, the tax written down value is greater than the sales proceed. It means what? You have a balancing allowance. What is the implication of that? It means that value will enjoy what? Will enjoy tax shield. That value will enjoy tax shield. What is tax shield? Tax savings. Or where it is what? A balancing charge. It means it is liable to tax. There will be payment of tax on it. So let's look at the issue of balancing charge. Balancing charge. Balancing charge. When we talk about balancing charge, it should be the reverse of balancing allowance. That is, this arises when the tax written down value, when the tax written down value when the tax written down value from the preceding year, from the preceding year, from the preceding year is lower than the sales proceed. It's lower than the sales proceed. It's lower than the sales proceed at final disposal. Final disposal. Final disposal of the assets. So in this case, it will be in what form? Tax written down value is less than the sales proceed. So in this case, what will be the effect of tax? The result will be taxable. In case of balancing charge, there will be payment of tax. In case of balancing allowance, what will happen? There will be tax shield. So let's take note of these definitions. So going back to the issue of our straight line method of computing capital allowance, we can just pick a simple example to illustrate this. Yes, to just illustrate this. Let's see. SYZ Limited. SYZ Limited purchase an asset costing 120,000 naira and has an expected economic life of 5 years. With no residual value. If depreciation is allowed, for tax purposes, over 5 years, using straight line This is straight line method. Okay, if depreciation is allowed for tax purposes over 5 years using straight line method. Using straight line method. Tax rate is 30%, and the scrap value of the assets at the end of the 5 years, end of the 5 years is nil. Required. Calculate the tax savings on the annual capital allowance. The annual capital allowance. So this is very direct. Is as far as this class is concerned, we should be able to solve this without any much ado. The solution.
Hello, good evening, sir.
Good evening, ma'am.
We are copying the
Good evening,
example,
sir.
please.
Please, sir, I joined late. I'm sorry for that. Please, I only met you when you were describing you were talking about the balancing charge. So I don't know, maybe you can just scroll up again. So that we understand the way you are going to do it, please, sir.
All right.
If possible, if not, let's continue.
Let's see.
I'm sorry, sir.
So this is what we just explained about the issue of the types of capital allowance. Yes, types of capital allowance. So we talked about the initial allowance, that this is claimable once in the lifetime of the assets. We talked about annual allowance, that this is granted every year until final disposal of the assets. And we talked about the balancing allowance, that this will arise when the tax written down value from the preceding year. It means when the tax written down value in year one is greater than what? The sales proceed. Let's assume the asset will just last for 1 year. And as at the end of 1 year, you want to sell that asset. Making tax written down value to what? Carrying amount in our normal account. Yes, in our normal account. So when the sales proceed is greater than the tax written down value, you have issue of what? Balancing allowance. But where the sales proceed is less than the tax written down value, what you have is what? The balancing charge. The balancing charge. So we're still going to show the format, the practical scenarios of how to express all this. Yes, as we go on. Hope this is fine.
Yes, sir. Thank you, sir. Thank you, sir.
So for this question, we had to calculate the tax savings on annual capital allowance. The tax savings on annual capital allowance. So I explained something, that tax savings on capital allowance is calculated in what manner? First, you will need to get what? The value of your capital allowance. Take notes. In taxation, instead of saying depreciation, you say what? Capital allowance. So once you determine the value of your capital allowance, you apply what? The tax rate on your capital allowance. The result you have will be what? Your tax savings. Your tax savings. Now, looking at this question, that we should calculate the tax savings on annual capital allowance. What will be our capital allowance using the straight line approach?
24,000, sir.
All right. So, using the straight line approach, the cost in the question is what? Is
120,000.
120,000. And the scrap value is what? Is nil, which is 0. So the useful life of the asset is what? It's 5. So this will give you what? The capital allowance value. So the capital allowance, annual capital allowance will be what? 24,000. The annual capital allowance will be what? Will be 24,000. 4,000. Now, the question is asking us that what? Calculate the tax savings on the annual capital allowance. The tax savings on the annual capital allowance will be what? The tax rate is what?
7,000.
30%. So 30%
of 24,000.
yes, 30% of the annual capital allowance will give you the tax savings. Take note, follow, so that when we start moving, I know why I say everybody should join early, because it can be, but once you get it, you enjoy every questions that you see. Yeah, so 30% multiplied by what? By 24,000. We have it as what? This will be 7,200. So this will be the tax savings per annum, because we are applying what? The straight line approach. We're applying the straight line approach. The straight line approach. We're applying the straight line approach. Yes, this can be direct. Now, somebody should ask, or somebody might be asking, what is tax savings? We've been hammering on the word tax savings right from the time we were solving questions on cost of capital. Cost of capital. That these are tax shields, tax benefits. These are in form of incentives, yes, given for venturing into a particular line of business or for getting a particular form of loan. Yes, so these tax savings, the fact that you're able to get these assets, yes, there'll be a relief for you. So that is tax savings. Now, looking at the reducing balancing method, which is another way to compute capital allowance. The reducing balancing method. This reducing balancing method is a method in computing capital allowance in which the value of the capital allowance reduce, yes, diminish, yes, based on what? The current value of the capital allowance, deducting it from the carrying amount. You get another tax written down value. Applying the depreciation rate on the current carrying value, the results, you less from the carrying amount, you have another balance. So it keep reducing in that order. So the reducing balance approach in solving questions on capital allowance is similar to what we know in our normal financial accounting, yes, but with the issue of tax savings associated with it now. You can see in the case of straight line method, we have the issue of tax savings. So in solving question on reducing balance, that involve reducing balance, we also consider the issue of tax savings. So the capital allowance is calculated by multiplying the capital allowance rate by the tax written down value of the asset. So looking at the reducing balancing method, let's show a format.
Hello, sir.
Yes, ma'am.
Please, sir, in this solution now, where is the tax written down value?
The tax written down value is this capital allowance. The capital allowance is the written down value. You understand?
Okay.
Yes,
Thank
is the written down value. You know, we said in our normal accounting, we have the carrying amount. The equivalent of carrying amount is the what? Is a tax written down value in terms of taxation. Let's show this. This will make it more clearer. Let's show this. Let's say calculating tax savings. Tax savings on capital allowance. Calculating tax savings on capital allowance. So we can have this format. And this format is what you always see when trying, or you always use rather, when trying to solve questions that involve capital allowance. So we can have the year. We can have the costs. We can have the tax saved on capital allowance. At what? The company's tax rates. At the company's tax rate. Please, you can write it in full. At company's tax rates. You can have it somewhere. So that you begin to look for the meaning of CTR. So we can have the first year of investment. Can have the costs. And the costs, this is just a format. As at the first year, we can have what? We can have our capital allowance. Our capital allowance at the capital allowance rate. We can have what? Capital allowance. Please take note, CA is capital allowance. CA is capital allowance at what? Capital allowance rates. Capital allowance rates. So once you have that, you less the difference between your cost and the capital allowance rate. That is your capital allowance at the capital allowance rate will give you what? I want to get a response. You know, this is just like this is your cost, this is your depreciation. So what will be the results? I've mentioned
tax written down value.
Fine. To be tax written down value. Tax written down value. This will be in brackets, please. Tax written down value. Now, for you to get your tax savings, what will you do?
You
I want to know.
times you times the tax written down value with you times the depreciation, that's the capital allowance with the percentage given. Sure.
All right, fine. Yes. So for you to get the tax savings, for you to get your tax savings, what do? You multiply the capital allowance, that is this value here, the capital allowance, by what? You multiply it by
Tax
what?
given, the
By
tax
the,
given.
by the tax rate given. Capital allowance by the tax rates.
So I think we should use figure.
This is a format. We are going to use figure. We're going to solve an example. Yes, just follow what I'm doing. So I'm just showing a format. So the capital allowance multiplied by what? The tax rate given in the question. Multiplied by the tax rate given in the question. So this tax written down value is for what? For year one. As at year two, you compute your capital allowance based on this value here. As at year two, we have it as what? Your capital allowance at what? At the capital allowance rate. At the capital allowance rate, that is at CAR. So once you do that, you're going to have the capital allowance. The capital allowance. The capital allowance. So once you have the capital allowance, for you to get the tax saved as at year two, the tax savings as at year two, it will be what? It will be this value of capital allowance multiplied by what? The tax rates. So the difference between your tax written down value and the capital allowance as at year two will give you what? Another what? Tax written down value.
For you. Yeah.
Tax written down value. So we have it as this. For you to move to year three, for you to move to year three, let's assume the assets just have 3 years lifespan. 3 years lifespan. Now, as at year three, we're going to have a sales proceed. A sales proceed. Let's assume we have a sales proceed as at the end of year two, rather, year two. Yeah, the sales proceed as at the end of year two. If our sales proceed is greater than our tax written down value, what will be our result? Let's say we have a sales proceed here. To make this format short, we have a sales proceed here. If our sales proceed
It will be balancing charge.
is let's say negative, yes, our sales proceed is, if the sales proceed is negative and is less than the tax written down value, so we said it is what?
It's balancing allowance.
It will be balancing allowance. It means tax will be charged on it. But where it is the other way around, it will be what? The balancing
Charge.
Balancing charge. We'll pick an example to show all this in figures. Pick an example to show this in figure. Let's take this example to explain this. Yes, Mr. Shaibu.
Good evening, sir.
Good evening,
So
sir.
in this method, reducing balance, my question is that in a situation whereby the cost and the scrap value were given and the rate wasn't given, how can someone able to solve it?
If the cost and the scrap value is not given,
Is given, but the
yes,
rate wasn't given.
the scrap value will be your sales proceed.
I mean, I'm talking. My question is that now issue of rate. The rate, if the cost and the scrap value is given, and then
Yes.
the rate wasn't given, and they ask you to use a reducing balance method. So how someone is going to solve it?
Definitely, for you to solve question on tax savings, tax shield, they will give you a rate.
Okay.
I said maybe you have a question that is not having a rate. Do you have an example of such question?
No. I'm just assuming.
Okay, all right. No, you don't need to assume. You assume based on standard.
Okay. Because there's one question I saw it in the FR that they asked them to use a reduced balance, but the rate wasn't given. But they asked them to work for it and get the rate before solving.
So
That's what I'm
that
asking.
FR approach, FR issue is different from this case now.
Okay.
Yes.
Okay.
When you
Thank
are
you.
solving reducing balancing in FR, they will not give you issue of tax savings. You are not saving for tax purpose. Yes.
Okay, sir. Okay. Thank you, sir.
So looking at this example, example, ABC Limited purchase an asset which costs 120,000 naira. Tax allowable depreciation is 25% on reducing balancing method. Tax on profits. Tax on profits. Tax on profits is payable. It's payable at what? At the rate. At the rate of 30%. At the rate of 30%. Calculates the annual tax savings. The annual tax savings on capital allowance. Capital allowance. So this is a question. So how are we going to go about this? So using this formula, this approach, to solve this, is follow. When we give assignments, we get the right solutions. So now, solution. Hope you all have the question, please. You can take a screenshot in case. So solution. We have it as this. We have our year. We have our costs. And we
What
have
about
what?
narration, sir? I think narration before cost, sir.
Okay, okay. Let's go by what we have anyway. And we can have our tax savings. Tax savings. So for the first year, we have our first year. That's year 1 to 5. If I'm not mistaken. Yes, 25%. 25%. So 25% indicates, we signify how many years, even though the number of years is not given. 25%.
4 years.
4 years. So it's not every time they will give you the number of years. 25%.
Why is 4 years?
25%
100 divided by 25.
So 25% in 100. How many times will you get it?
4.
4. So when you are doing reducing balancing and they're telling you 25% on reducing balancing method, it shows that the number of years will be what? Will range from year 1 to what? To year 4. From year 1 to year 4. So in the first year, what will be our capital allowance? In the first year, based on the question.
30,000. 30,000.
Fine. 30,000. Then what will be your past savings?
9,000.
As simple as that.
I'm lost, sir.
I'm not yet showing it. We're just doing oral. So this is it at year 1. You shouldn't be lost after I showed it. And so the narration is cost, right? What is the cost?
120,000.
120,000.
Is naira. So we have it as 120. 120. Now, your capital allowance. What is the rate of your capital allowance?
25%.
Capital allowance is what? 25%. 25% of what? Of 120. When you do that, what will be your result, sir?
30,000.
30,000. Less. 30,000. The difference between the costs and the capital allowance will give you what?
Value. Tax return down value.
That's 18
Fine.
value.
Tax written down value. Tax written down value. TWDV. And that will result into what?
90,000.
90,000.
As at year 1, what will be your tax savings?
9,000.
Yes. That is, in the question, we have 30%. Tax on profit is payable at the rate of 30%. So our tax savings, the tax rate is what? 30%. So 30%
Of 30,000.
on the capital allowance, which is 30,000, we give you your tax savings, which will be what? 9,000. Is this clear, please?
Yes, sir.
Fine.
Good.
Moving to year 2. Moving to year 2. What will be your capital allowance?
22,500.
It will be on this 90,000 here. Is reducing
Yes, sir.
balance. So it
Yes,
will be
sir.
what? The capital allowance
22,000.
at what? 25,000 at 25% rather. Multiply by what? 90,000. This will give you what?
22,500.
22,500.
22,500. Your tax savings for this year will be what?
6,750.
6,750.
That is 30% of what? 22,500. And this will give us what? 6,750. So the difference between 90 and 22,500 will give you what? Your tax written down value. Tax written down value. And that will be what? In normal accounting, we call this carrying amount. But in this case, we refer to it as what? Tax written down value. So this will give us what?
67,500.
67.
7,500.
Moving to the third year. To the third year.
Mr. Papa, good evening, sir.
Good evening.
Please, how did we get our 90,000?
120
For the second
minus,
year.
120 minus 30,000 will give us what?
Okay, 90,000.
Is that all, ma?
Yes, sir.
All right. So now, for the third year, your capital allowance will be what?
16,875.
Capital allowance will be 25% of what? Of 67,500. And these will give us what? 16,875.
875.
16,875. 16,875. Based on these, what will be your tax savings?
5063.
30% of what? 16,875. These will give us what?
50,63 approximately.
5063. Now, the difference between 67,500 and 16,875 will give us what? Tax written down value.
50,625.
50,625. Now, as at year 4, what will be your capital allowance?
12,656.
50.
That's year 4.
665.
So we have our capital allowance will be what? 25%
12,656.
of 50,625. We have it as what? 12,656. So your tax savings as at this period will be what?
3,797.
3,797. Now, what would be your tax written down value as at the end of year 4? As at the end of year 4.
37,969.
And the difference between 50,625 less 12,656, 37.
Yes, sir. 37,969.
Now, the question, do we have sales scrap value from the question?
No, sir.
That's yeah, sorry. I lost connection. Sorry, I lost connection. Hello, can you hear me?
Yes, we can hear you, sir.
All right.
Yes, sir.
Yes, I lost connection. The screen will come up soon. So, talking about the issue of the sales proceed, and the question sales proceed is not given, sales proceed is 0. So I'm now saying that where you have your tax written down value as at the end of the useful life of the asset being greater than the sales proceed, what will you call the outcome from our previous explanation?
Balancing charge.
Okay, where the sales proceed, where the tax written down value is greater than the sales proceed,
It will be balancing allowance.
All right, balancing allowance. Balancing allowance. But where
Now
the
that there's
sales,
no sales proceed, what are we going to call it?
you still represent it as a line item, putting it as 0. It still shows that tax written down value is
It's
higher
higher.
than 0. So you still show, I will still show it that is 37,969 minus 0 is 37,969, which is what our
Screen
balancing
is not coming up. Your screen have not come up yet.
it will come up, man. So where we have the tax written down value greater than the sales proceed, it is balancing allowance. And this balancing allowance, are we going to subject it to tax? The answer is
No, sir.
you will not subject your balancing allowance to tax. It is subject to tax. The balancing allowance is subject to tax. It is when you have the balancing charge that you not subject it to tax. Is balancing allowance will enjoy what we call the tax savings.
Tax savings.
Enjoying a tax savings. So it is not, yes, it is not subject to tax, as you said, but it will enjoy what we call tax savings. It will reduce the amount you are paying for tax. Yes. So it will still enjoying that 30% of tax savings. Can you still hear me, please?
Just
Yes,
now.
sir. Yes, sir.
Okay. I'm trying to be.
Sir, excuse me, sir.
All right, sir.
Before your screen come up, this our number 4.
Yes.
Number 4, we have I think the cost that you bring to our narration, I mean to our cost as narration side. Now is 5062.5. Then 25% multiplied by that figure. What I get here is 1,000,000, I mean 1,265.625. But what I saw in the screen, whether it's me that do the mistake, I don't know. I saw 12,656.
Hello, sir. I can't hear you.
Okay, this point number 4, the tax
Yes,
written
sir.
down value. When you see naira, we have 50625, right?
Yes.
Then capital allowance 25% multiplied by that 50. I think
Yes, sir.
what I did. Okay, it's 12,000. It's like I'm the one that do the mistake. It's like it's me. So let me try again.
All right, sir. Thank you, sir.
Yeah, thank you, sir.
So the tax written down value being greater than the sales proceed, you're going to have a result of what term as what balancing allowance. Balancing allowance. Going to have balancing allowance to be 37,969. So what will be the tax savings on this value? The tax savings on 37,969 will be what? That is 37 696 multiplied by what? 30%.
11,391.
11,391.
Size is 37,969, not 696.
37,969. So when we multiply that by 30%, you have 11,391. 11,391. So based on reducing balancing method, any question? So this will serve as workings to questions that will come your way. Yes, they will serve as workings to questions that will come your way. So for you to get good marks when trying to solve some MPV questions, investment appraisal questions, you must understand this concept. Yes, you must understand this. So there are quite a number of things that we need to know. Let me state one again. In solving questions on MPV or investment appraisal, capital allowance can be claimed in the current year or in arrears. Take note, capital allowance can be claimed either in the current year or in arrears. When capital allowance is claimed in the current year, it means it will be recognized in that particular year. If it's capital allowance for year one, to be recognized in year one. But where capital allowance is claimed in arrears, it means the value of year one capital allowance will be claimed in what year? In year two. The value of year two capital allowance will be claimed in what? In year three. In year three. So the question is this: why do we calculate capital allowance? Why do we calculate capital allowance? This capital allowance or tax savings, they are used to reduce what? Taxable profits. They are used to reduce taxable profits. And when you use this to reduce taxable profits, what will happen? This will reduce your final tax liability. Yes. So this will reduce your final tax liability based on the fact that you purchase or incur qualifying capital. Encourage people to get certain forms of assets. You enjoy capital allowance. You enjoy capital allowance. So this will help you to reduce what? Your tax liability. To help you to reduce your tax liability. Your tax liability. That is why we compute capital allowance. Now, for you to solve questions on net present value, you know, the ones we've been solving before is how to determine MPV, yes, in one form. Now, for you to solve questions on MPV, there is a format. There is a format. There are quite a number of formats.
Sorry, sir. I'm so sorry, sir.
I'm with you, sir.
Okay. See, yeah, this number 3, tax savings. We have a 30% multiplied by 16,875 naira. It will give you equals to 5063. Oh, when I did it, what it gave me is a 5062.5. So, and it,
Hello.
sir, can you hear me?
Sorry, I didn't get you, sir.
Okay, this number 3 has savings.
All right.
Cash savings, number 3, 30% multiplied by 16,875 equals to what you put down there is 5063. But when I did my own, it's giving me 5062.5.
So that is approximation, sir. That is approximation.
Okay, that's what lead us to 50,000 in tax written down value, right?
No, 67,500 less 16,875 will give you 50.
Yeah, I get the, okay, go ahead, sir. Thank you, sir.
So to solve questions on MPV, there is a format that we must follow. There is a format. I said there are quite a number of formats, but I'm going to show one. Yes, because this format is very important. If you go to the pilot question, one of the questions in the ICANN FM pilot question, you see a question on MPV. We solved that during the revision class last date. Yes. And the question I forwarded to the platform, the Microsoft Word documents I sent to the platform, is also a question that involves MPV. Yes. For you to compute or determine your relevant cash flows and try to solve by using your net present value. Yes. So there's a format. There is a format to solve questions on that. So I will show the format. Then as I show the format, we'll quickly run to that question I sent on the group and see how we can solve it. So let me show the format. I'm showing the format. I just don't want to jump into that question. So this format will guide us in solving that question. So that is the essence of showing the format. So let me present it this way. Format for calculating MPV. Format for calculating net present value. Net present value. If you go to different literatures, you see them presenting it in different ways. All will lead you to the same results. Yes, all will lead you to the same results. Because some students can so confuse themselves. You jump from one literature to another, you see different approach, but you not take your time to study the methodology of what the author have put down. So sometimes we get confused. So from my analysis, I discovered everything is leading towards same result. Will lead you to same result. To same result. Yes. So the format. So let me put it this way. So the following formats can be used to calculate NPV. Calculate NPV when there are multiple variables. When there are multiple variables. What is the format? We can have our years. Yeah, we can have year 0. Year 0 is usually the time for investments. can have here 0, can have here 1, can have here 2, can have here 3, and have here 4 likewise, depending on the question. So sometimes the question can be given in million. You can suspend the zeros that translate to millions. Yes, you can suspend those values so that and suspend those values. But if you know suspending it will cause confusion to you, you can begin to write the whole millions. So depending on what the question is saying, yes. And sometimes some people reducing those zeros can get them confused. So work in the way you know. So you can suspend them. So we have it. So the first thing, what are we trying to determine? We're trying to determine our profits. Some questions we want you to determine your cash flow, but all we're trying to ascertain is our net cash flow using this approach. But first, we can determine our profits. Now, how do we determine our profits? We have our sales. We have our sales. In year 0 is the time of investment. You might not have sales. The sales value will be dash, be nil. So in year 1, you can have sales value. In year 2, you can have sales value. In year 3, you can have sales value. Likewise, in year 4, you can have sales value. It is at this point you should know what relevant cash flows are. You should know what is relevant. Now, what are relevant cash flows? Because it's not every figure you see in a question you just put when trying to solve. What are relevant cash flows? What are relevant cash flows? I've explained this before. What are relevant cash flows? I will say it again. I will explain that again because this is very important. Once you don't know what relevant cash flow are, that is up. So cash flow is one of the variables required in determining the financial viability of a project. That is when you use discounting technique such as NPV and internal rate of return. So these cash flows must relate to the future and directly attributable to the what? To the course of action. So in making investment decision, there are certain items that you should carefully consider when trying to ascertain relevant cash flow. Number 1 is variable cost. Variable costs are always relevant because they are related to the decision that is to be taken in future. So the more products you want to produce, the more variable costs you incur. The less products you want to produce, the less variable costs you incur. So variable costs are relevant costs that can directly attribute level to activity level. So that is, if activity level changes, the total variable cost will also change. However, variable cost per unit does not change like that. So you must note that. When we talk about fixed costs, are fixed costs relevant? Are fixed costs relevant?
No, sir.
Irrelevant, sir.
Yes, there are some costs.
Yes. But take note, some fixed costs can be relevant.
Yes,
Take note.
incremental fixed cost.
The incremental.
Yeah, so where a question is telling you that based on additional production, the following fixed cost was incurred, is relevant, because it is as a result of a decision that is to be taken that you decided to obtain the fixed cost. So fixed costs, these are costs that have no sympathy for activity level. The fact that you have a capacity level of 1 million and you are producing 500 units, the fixed cost will not reduce itself. It will still remain constant. So it is not relevant. It is not relevant, except where it is what? Incremental in nature. So the fixed cost is that irrespective of the number of units produced, fixed cost does not change. So it is an irrelevant cost and should be ignored, except where it is what? A direct or incremental value, or incremental in nature. That is where you acknowledge it as relevant. So the issue of depreciation also is what? Is irrelevant. Take note of that. When you see it in a question, it is irrelevant, because this is a non-cash item and it does not involve the movement of cash. So depreciation is an irrelevant cost and should be what? Ignored. Take note. The question will not tell you, you are the one that will filter it. This is not relevant. This is not relevant.
Amortization, sir. Amortization.
Fine. They are in the same family of depreciation. So also the issue of interest. The issue of interest. Now, when you see interest in an MPV question, it is not relevant, because when trying to solve this question, you will always have the cost of capital given in the question. In the cost of capital, there is an interest element. So trying to acknowledge interest as part of your cash flow will result into what we call double counting. Because in the cost of capital given in the question, there is an interest element. When you go back to the elementary where we try to solve cost of capital, cost of debt, you discover there is an interest element in trying to obtain cost of debt. So when you are given a question and you see interest, it is not relevant. It is not relevant. So this interest is a compensation for the use of specific, for the use of funds for a period of time. So it is the amount charged, and this is expressed as a percentage of principal. Lender, or by the lender, yes, or by the bank to the borrower for the use of a resource or asset. So interest should not be considered while determining relevant cash flow, because it has already been incorporated in the cost of capital. So doing this, incorporating it again, will result in what? In double counting or double dipping. Yes. So take note of that. Now, these are issues you must note when trying to solve question. Another one is issue of working capital. Working capital. Is working capital relevant or not? Let's ask ourselves. Working capital. The question is, what is working capital? Is a topic on its own in financial management. So when we talk about working capital, is it a relevant cash flow? Think about it practically.
Yes, sir.
I think
Yes.
it is.
So
It is.
in the determination of relevant cash flow, working capital should be considered, because working capital most times is what you need as at the beginning of the investment. And in most questions, they will tell you that working capital will be recouped as at the end of the period. It means when you are solving a question and the question says that working capital will be recovered as at the end of year 4. It means as at the end of year 4, it will be an inflow, but as at the beginning of the business, is an outflow. So when working capital should be treated as a cash outflow in year 0. Take note. All what I'm saying, they are very important, so that when we start treating questions, you understand the flow. So working capital should be treated as cash outflow in year 0, or in a year before the year of occurrence, and it will be recovered fully at the end of the useful life of the project. But take note, where there is incremental working capital, only the incremental value should be considered. Yes, especially in that question I was talking about in PM. While we're treating the question in that last diet, so many students didn't understand the concept of incremental working capital. If you go to the question, you see the effect of incremental working capital. The increment of year 2 over year 1, the increment of year 3 over year 2, the increment of year 4 over year 3, the increment of year 5 over year 4 is what is being considered each year, not the whole lump sum of the working capital. So let's take note of this. Now, there's another point in considering our relevant cash flow. There's what we call opportunity cost. Opportunity cost. When we talk about opportunity cost, this is an alternative that is given up when making investment decision. So it is the benefit that is foregone as a result of pursuing a particular course of action. So if I should ask you, is opportunity cost relevant or not relevant? What will you say?
Relevant.
It's relevant.
It is relevant because you have to sacrifice this to make sure you achieve this. So it is based on the decision that you have to make, and that is why this cost is coming in. So opportunity cost is a relevant cash flow and should be what? Should be considered. Also, the issue of sunk costs, which we all know, these are past costs that have already been incurred. So they are historical costs which have no impact in making future investment decisions. So we all know that some of these costs are development costs, the market research costs, and so on and so forth. So let's quickly run through this format. Very important, so that we take the example. We can't take the example, we'll take it in the next class. So that but I hope I can take it so that the assignment I have, I'll be able to dish it out. But if I didn't take this question, I won't be able to give the assignment. So we have cells, then you can have your variable costs. Now I'm just putting everything together. The variable cost can be direct material, direct labor, and the rest. Take note, please. You can have variable costs. So in year 0, it might be nil. So in year 1, you can have a variable cost. In year 2, you can have a variable cost. In year 3, you can have a variable cost. In year 4, you can have a variable cost. And another thing that we have to consider, I mentioned issue of incremental or specific fixed costs. Once you have that, you acknowledge that. You acknowledge that as being relevant. Is it a question? Incremental?
Yes, sir.
Please, what is the question?
Okay, sorry, sir. We did with that one we did balancing allowance. Can we get like the one that will also do the balancing chart? I want to know how it's being
It
done.
is the inverse. It is a format we've shown, which is the inverse, where where your sales proceed is greater than your tax written down value as at the end of the year. What is it called? It's the same format.
No, I
Where
know
your
how it's going to be presented, because the other one is this still the same way they're going to be presented, just that you write that it's balancing chart. I don't know. Sure.
Yes, and that is why we have it in the format. Where is the format? that is why I have these two things here. It's either balancing allowance or balancing charge. So where the sales proceed is greater than the tax written down value, you have the charge. Where the tax written down value is greater than the sales proceed, you have the balancing allowance. So where it is stated that using reducing balancing method, you run its same approach. Yes. So it is your final results that will determine either balancing allowance or balancing charge. So we have the incremental or specific fees cost. Where you have that in the question, you know it is relevant, so it will be considered as a relevant cash flow. So where you have all these, there can be more, but it will be classified in this category, variable costs or incremental or specific fixed costs. So the difference between your sales and your variable costs and your incremental fixed costs will give you what? Will give you profit. Will result into what? Profit. Into profit. So you have a profit. So once you have a profit, what will you do? You can determine your tax liability. Yes, you can determine your tax liability based on the tax rate given. How do you determine your tax liability? You multiply the tax rate by the profit, to get what? The tax liability. This is just a format. As I've said, there are different approach. So we have, can have your tax liability, and that will be at, that can be at what? The company tax rate, at the tax rate given. So you have your tax liability is an expense. Is an expense. So we have it. We have it in this order. So also, you can have what we call your tax saved, tax savings on capital allowance. The tax savings on capital allowance, is it an outflow or inflow?
An inflow.
It's an inflow.
Inflow.
It's reducing your tax. Yes. So tax saved on capital allowance. Tax saved on capital allowance is an inflow. So you have it as this. Tax saved on capital allowance is an inflow. So once you come up with this format, where are you driving at? You want to determine your net cash flow. You can come up with a next column where you can have your scrap value.
Okay.
You know your scrap value as at the end of the period. Will it be an income or an expense?
Should be an income.
Income.
Your scrap will be an income. So you can have it scrap value. Scrap value. Let's say you have 5-year period. You have an income as at the end of that period. So you can also move further. You can move further to look at your initial outlay. You can move further to look at your initial outlay. That is what? Your costs. The cost of your investment. Initial outlay. Initial outlay. The initial outlay is the cost of investing as at what? As at year zero. As at year zero. So as at year zero, what is that value? Is an outflow. To be an outflow, you are giving out as at year zero. What other thing can you have? The issue of working capital. working capital. You need working capital to run your business. So working capital is revolving and it can be incremental. So working capital as at the beginning will be an outflow.
Take this one first. Take the laptop.
Working capital will be an outflow as at year 0. As at the end of the period, it will be recovered. It will be recovered because it's what you are using to run your business. Definitely, when the business will cease, you definitely get it back. So, and as at that period, it will be what? An inflow. It will be an inflow. So, your net cash flow will now be what? Your net cash flow will now be what? Net cash flow. At this point, you can determine your net cash flow. Your net cash flow, as at year 0, it will be what? This value plus this value. When you add both together, they are both negative, or negative plus negative. What will be the outcome? The total value of negative. So you have it. You have a value here. So as at this point here, you have a profit. You have a tax. This profit less tax plus tax save will give you the net cash flow as at year 1. That will be a positive value in most times, depending on the question. In year 2, same. Your profit less your tax liability plus your tax save will give you your net cash flow. Also, in year 3, your profit less your tax liability plus your tax save will give you your net cash flow. And in year 4, your profits less your tax liability plus your tax save will give you what? Your net cash flow. What will you do with this net cash flow? You use this net cash flow to determine what? Your present value. To determine what? Your present value. Your present value. And how will you determine your present value? You'll be given a discount factor in the question. You'll be given a cost of capital. You'll be given an hurdle rate in the question. What will you do with it? You use it to discount. Please, let's mute ourselves.
Auntie.
You sit down there, all the shout and shout.
It's serious.
Select beans, two cups.
It's serious. Ma, you're on the live on this
I'm
thing.
sorry,
I
sir,
post
I'm
my
really sorry.
YouTube. I post it on the YouTube. So net cash flow. Net cash flow. You have it. You need your discount factor to be given in the question. So discount factor, we're giving it in form of a percentage. Discount factor. So you use your discount factor. Your discount factor for year 1 will be what? Or year 0 will be what? Will be 1.
1.
I'll explain why it is 1 over time. Yes. So your discount factor in year 1, you know how to apply your discount factor. The formula 1 plus R to the power of minus N. Where you want to use annuity, it will be 1 minus into the bracket of 1 plus R to the power of minus N divided by R. Yes, we've shown those formulas over time while we're introducing NPV and the rest of them. So now, for year 1, you have a value that have 0.xx. In year 2, you have a value once you discount 0.xx. In year 3, you have a value 0.xx. In year 4, you have a value 0.xx. Now, when you multiply your discount factor by the net cash flow, what will you have? You have what? Your present value. You have your present value. You have your present value. Present value. So your present value, as at this point, to be negative. As at this point, you have a value. As at this point, you have a value. At this point, once you multiply, you have a value. As at this point, you have a value. So once you do that, the difference between the negative value and the positive value will give you what? Will give you your net present value. We give you your net present value. That is your NPV. Net present value. So once you do the difference, you have a value to the term as what? Your net present value. Your net present value. Any question about this? Any question about this?
Okay, so
I want you to learn.
this our net present value. Why is it that you
Yes.
have figure is only have figure in year 3? Why not 1 or 2? I mean,
The present value is not for year 3. The present, that value of XS is not for year 3. Is the overall value you derive for you to be able to appraise a project. If it is positive, you give a recommendation. If it is negative, you give a recommendation. So it's the difference between this negative here and the summation of all these. When you say this positive, negative minus the whole positive, it will give you a single value. And the single value is this. It is on this basis you give an advice. If it is positive, it shows it is variable. If it is negative, it shows it's not worthwhile to invest in the project. Is this clear, please?
Is this clear, please? Sir, this net cash flow, is it that balance of tax saved on capital allowance? Is it that figure we're bringing down?
Right, can you mute yourself?
Can you hear me? The net cash flow, is it the balance of?
Yes, I can hear you very well. I just need you to mute yourself so that you will not have a vibration of the sound. These the net cash flow. How do we get the net cash flow? In year 0, it is your initial outlay plus what? Your working capital. You have your net cash flow. For year 1, it is what? Your profit minus tax liability plus tax saved. You have what? Your net cash flow. The positive value less the negative plus the positive. In year 2, this profit here less your tax liability plus your tax saved, you have your net cash flow. There is a difference between your inflow and your outflow. The outflow is denoted in what? In brackets. This value in brackets is an outflow, shows a negative value. So from your profit point here, less your tax liability plus your tax saved, you have what? Your net cash flow. Your profits less your tax liability plus your tax saved, you have what? Your net cash flow. I don't know if that is fine, sir.
Understand now.
Okay, so please say this our scrap value and the figure have been the last year. So if you want to calculate it, how are you going to calculate that aspect, sir?
Yes, the scrap value can be determined by you calculating the depreciation. It will be given in the question. Where it is not given and they want you to calculate it, they'll give you the appropriate variables for you to calculate the scrap value. And sometimes take note, it might not be stated scrap value in the question, it might be stated sales proceed. Scrap value is the value you dispose the asset. You understand? When it is no longer useful to you. So it can be termed salvage value, it can be termed sales proceed, and that is why it is coming as an income at the end of the project. Is that fine, please?
Yes, sir, it's good. Thank
All right. So I want us to go and digest this format. Go and study it. That question, this question, decide to solve it, take us time. So go and digest this, and then we'll solve the question in the next class. Please make sure you study these formats, everything we've talked about. If not, when we pick a question, it will be an issue. And if you have the strength, if you think you can attempt that question based on this explanation, please go ahead. We'll solve that in the next class. And I will now serve you with another question. The question is on the platform, the Microsoft Word question. The documents I forwarded before the class. So the recordings will be made available likewise once it drops on my mail. So it's good you go and study this thing. When you study it, you enjoy the topic more. So I think it has been designed that I will not solve that question tonight. So that I want everybody to be on the same page. Yeah, some persons are used to this very well. Some persons are just seeing it and it's looking like a film trick. So go write it out. Don't follow what I will send to you in slide. Get your book, write all this. Yes. Flow with it. That is the way to learn this concept. Yes, some people they will not write it out. They don't have time. Even in you not having time, create time to write these things out. It's not a waste of time, but it's a way of learning. Yes, so that is what I will say for now. So we'll meet on Sunday, God's willing. Then we'll solve the question. I'm just very much busy. I could have created time on Saturday morning to solve that question because it means I'm having more work to do to solve the question I forwarded, so that when we meet on Sunday, we'll move ahead again. But I don't have the time for now. But we'll meet on Sunday evening to solve this question. But do well to go over all these again. Thank you very much.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you, sir. God bless you.
Thank you, sir. God bless you.
Thank you, sir. Good night.
Right.